Good day, fellow investors. We recently discussed Berkshire's meeting, and the key topic you wanted to discuss further is whether Buffett is timing. He is timing the market, how he is planning on that, projecting the future, because you need to know something about the future to time the market, and other topics you saw important there. Thank you for the already 20,000 views on that video. And let's start with the key comment. He's actually timing the market like he did in 2005-06 with a high allocation to cash. Investing, timing the market, or as someone said, a fancy explanation for timing the market. So it's clear that Mr. Buffett times the market. He's patient and waits on those opportunities. And he is probably waiting 2-3 years, as long as it takes, deficit, recession, bad earnings for companies that will lower valuation and create buying opportunities. Then we can argue whether Buffett is timing the market or he's just preparing for the rare moments when irrational fear creates extraordinary value, which is again timing the market. But he also said that he's not running a business where he does just transactions, so his business is very, very, very opportunistic, to quote Warren Buffett. And that just investing now, whatever the price is, would be the dumbest thing in the world. Things get extraordinarily attractive very occasionally. The long trend, yes, it's up, but you need to wait to beat the market. So in order to beat the market, Warren Buffett says you need to time the market, at least partially. And there are the following components there. First, we have investing. You say, okay, I'm going to invest if I find an investment that will give me, with a high degree of certainty, 10%. If I don't get that 10% from a business, I'm happier with 4% from treasuries. And that is what Buffett is doing. He's waiting for the right opportunities, and he knows that sooner or later those opportunities will come, and then he will make his extraordinary returns. An example on that is that he did spend 10 billion, how much, on Occidental, because the likely long-term yield on that is 10% plus. However, he can find bigger opportunities to get that 8 to 10% yield. And speaking of that market structural change going forward, as in this comment by Charles, the key question is, how is he predicting that? Well, he looks at valuations. There is the Buffett indicator, government debt, all the risks that are piling. Let's look at valuation. If you look at the S&P 500, there are times of exuberance, times of desperation, high, low, high, low, high, low, cut out the crisis here. And now we are again very, very high. The mean is 15, 16. The P ratio of the S&P 500 is 26. Each time the P ratio was this high, the returns were very, very bad going forward. Plus, if you look at the P ratio now, all good, that's a 4% earnings yield. 4% is in line with the US Treasuries. Usually there is a 2 percentage point premium that stocks offer. Thus, the current return from stocks should be 6%, which is 30% down from the current level. And then it's better to have no risk treasuries here than high risk stocks, because if this happens, this is 30-40% down with larger market shocks. The thing is that the market still expects long-term rates to be low because of the last 15 years of low interest rates, but Buffett has been investing since here, so he has seen how interest rates can go higher and higher, and he has seen interest rates going lower and lower. He's not going to risk everything on a bet that the Fed will lower rates. Plus, if you look at this, the Warren Buffett ratio, which takes into account the Wilshire 5000 to GDP ratio, the stock market capitalization to GDP ratio, it is at extreme historical highs, which clearly signals, again, market exuberance and irrationality. Further risks, if we just look at the deficits here piling and continue to pile like there is no tomorrow, further on the deficits, a reason there is no recession, there hasn't been a recession for the last 15 years, are those deficits. So if the government needs to start spending less, or is pressured by higher interest payments, just that could lead into a recession, new market valuations, and opportunities for Buffett. Another interesting position there, if interest rates change or their structural market changes, the private equity environment, which I'm sure Warren Buffett is looking carefully because at the end he is a private equity investor when he buys out businesses, those businesses are constantly buying new stakes, new this, they are just spending money no matter the price, no matter what, and Warren Buffett knows that this is unsustainable. So there are the risks piling, but the key question is when. Nobody knows when, we just know that it is unsustainable. But Warren Buffett has his money in 3-month treasuries, the rest is in great businesses, and therefore he's happy waiting here rather than risk it for 4% investing in crazy expensive businesses or doing with leverage like private equity does. Further, there is also the size issue for Berkshire. If you look at Berkshire, great comments here. For us, retail investors, there are international markets, emerging markets, small cap, you name it. And the thing is, we also discussed ADM in a video, and that ADM will likely return 10% long term. So he cannot put 10 billion on that because the market cap is just 20 billion. That is an issue, and that also explains why I'm fully invested. The largest position I have is 1.2 billion, so really something that would not move the needle for Warren. On Berkshire, going forward, he is very focused, but from the current perspective, especially from the current price perspective, long-term growth, 4 or 5%, reinvesting the money, so a return that you should be expecting for Berkshire is, yes, 40 billion per year plus 3-4% growth on that. So that is around 6-7%, nothing stellar, but still great for 99% of the population out there. There was a comment on volatility here on the insurance underwriting that was very positive in 2024, and now it is declining. It might be also negative, and you have to keep in mind here that Warren Buffett says their goal is not to make money on insurance underwriting, their goal is to keep the float and reinvest the float, gain money on that float, not on insurance. Insurance has great times. As inflation came down, the premium stayed higher in 2024. Now that might be changing a little bit, and therefore you have again pressures on insurance, so don't expect them to make the 10 billion they made last year, this year, or next year. Plus, if there is a catastrophe, there might be a 20 billion loss on that account. Insurance, forget about it, 1-2% is his goal of earning. Even if there is 0% earnings on insurance, he's happy because of the flow. Now, he is warning us, for sure. There were some comments, he wasn't clear about the dollar, but another comment, Buffett never warned more than this time. He was also, I think, pretty clear on the dollar. There is deficits, huge debts. It is very likely they're going to print inflation out the way of this over time. But perhaps Warren Buffett is waiting for a recession to buy cheaper. On Berkshire Successors, is it Pershing? Is it BlackRock? I don't think either of those are. BlackRock is buying whatever at any price, and Bill Ackman has too much of an ego to not make mistakes and just watch paint dry, like Warren Buffett has been doing for 50-60 years. Bill Ackman simply needs to be the smartest guy in the room all the time, and that costs him dearly usually. Costs him dearly when he sells Netflix because he gets in an argument with the CEO, and costs him dearly when he shorts something like Herbalife or things like that. And the key factor is watch paint dry, buy good businesses, and that's it. When it comes to retail investors, risk is most important, but also for any other investor, risk is most important. And then this crazy market situation, when Buffett announces that he's going to retire, or there is a hiccup in insurance earnings that we knew would be there, then the stock is down 6%. So the market is clueless not only on what's the real value, but they also don't know how to factor in anything. Now, when it comes to the long term, from Warren Buffett, warnings and everything, it's clear, as here the comment says, that we are few ahead. But also, am I saying, is it possible to time the market? I think that there is one clear conclusion that solves both of these problems, and this is the following. Great comment here. I imagine one of the more challenging aspects of what you do, Professor, is people expecting great ideas multiple times a month, when in reality it's more like maybe a handful in a lifetime. And this summarizes everything. If you can get this, if you can grasp this, that you just need a few right opportunities in your lifetime, compound on those, buy that opportunity at that right moment in time. In the next 5-10 years, you reinvest the dividends, build a new opportunity. Over 30, 40, 50 years, you have an amazing portfolio. Recession-proof, whatever, you just keep on compounding. That is the essence of Warren Buffett. Not predicting the market, not this, not that, just acquiring great businesses at fair prices, letting them grow, and then reinvesting. Warren Buffett has $300 billion in cash because Apple became exuberantly priced, and therefore he started slashing that position. If not, the position would not be that big in cash. That's a key component to know. So we cannot time the market. And it's not about timing the market. It's about grasping those great opportunities, and that is the key of investing. Just building one by one. And if I look at things from a longer term perspective, since we started this YouTube channel 8 years ago, copper was cheap. Commodities were cheap, so that was one. Then we had a short opportunity, 2020, commodities, oil, we bought that, all those things. We did really great there. And now I have a small business that I really like because of the compounding long term. But apart from that, I don't see great opportunities out there. And that's also what Warren Buffett is doing, just waiting for the right opportunity. And yes, I wish I could give you an opportunity every week, let's discuss this, let's discuss that, but that just increases the risk of your portfolio, and that's not watching paint dry. So if you can learn to watch paint dry, that's the essence of investing. Thanks for watching, subscribe for more watching paint dry, and I'll see you in the next video.